Everyone, Rose Brown, the accountant therapist here, and this is part 3 of my 4-part series where I'm breaking out why you owe taxes. So the last 2 videos covered the Form W-4 and tax credit. So if you've not yet seen those, make sure that you go ahead and check them out to ensure that those aren't the reason why you owe taxes, and if they were, go ahead and make the necessary adjustments moving forward so you're not in an uncomfortable situation of owing taxes. So today we're focusing on bonuses and employee stock option plans. Now, I'm going to tackle bonuses first because they don't have as many moving parts to them as an employee stock option. When it comes down to bonuses, they're generally processed at a 22% supplemental income tax rate. When I say supplemental income, I'm referring to not your regular wages, like other income, if you will, commission, bonuses, right? Anything that's outside of your regular wages. So as they're processing at 22%, this is a general thing. Some employers may adjust it, but employees may have to inquire of their employers to make that change. So ultimately, as they're withholding at 22%, you may or may not be in that tax bracket. You may be in the 24% or the 35%, which means they would be under withholding, which would then produce a tax bill when you file your tax return. So ultimately, under these circumstances, you first want to go ahead and inquire for your employer to withhold at your actual tax rate. Now, if it turns out that they're not doing that or they just can't because their system won't adjust, you will then have to entertain 2 other options, which is to opt into additional withholding, which is pretty much updating your W-4 to say, hey, take an extra amount out of my wages every time I get paid so that I can kind of play catch up. Or you can do estimated tax payments. Now, if you kind of do nothing, you can expect a tax bill when you file your tax return, plus interest and penalty for not making all your withholdings on time. Okay, so the second piece to this is the employee stock option plans. Now, I'll be talking about 4 of them. I'll give you the abbreviation as well as the actual words that go with them this week and follow along as I talk about them. But ultimately, as I talk about them, it's not necessarily on a general basis, but from a tax basis, right? So it's more focused on why you may have owed taxes based on these types of employee stock options. We'll start with ISOs, which means incentive stock option. Then you have ESPP, which means employee stock purchase plan. Then you have NSOs, or some people may refer to it as NQSO, which means non-qualified stock option. And then lastly, we have our RSUs, which means restricted stock units. Now, when it comes on to these employee stock options, they have a certain tax nature to them where a certain action/activity could trigger a taxable event. Now, they don't all necessarily have the same nature, but generally you want to make sure that you're reviewing that stock plan that you got from your employer to make sure that you understand which stock option you have in your possession. This way, whenever you do anything surrounding it, you understand the events that will take place after. Let's talk about what triggers a taxable event surrounding these employee stock options. So when it comes on to an ISO or a ESPP, it's when you sell them, right? So when you sell them, you trigger a taxable event. When it comes on to the NSOs, it's when you exercise. Exercise meaning you're exercising your right to purchase a certain stock option at a set price. As for the RSUs, it's when you vest. Vesting means you've now earned the right to these stock options based on criterias or conditions that you've met as an employee. Usually it's a vesting of 2 to 3 years. Now that we've talked about the taxable events, what triggers taxes to become a concern surrounding these employee stock options, we now have to look at how they're taxed, right? So similar to the bonuses, they're taxed at this 22% tax rate. So we've talked about what impact that has on you if that's not your current tax bracket. So it's the same thing here. Making sure that first, your employer is actually withholding from these employee stock options, and then making sure that it's not just the 22% tax bracket, but it's at your actual tax bracket based on what you've put on the W-4 and what your salary will be, okay? And then ultimately, you also want to make sure that if that's not taking place, you're kind of taking things into your own hand, opting into additional withholding and or just doing estimated tax payments. Again, if you don't do anything, you can expect that tax bill along with penalties and interest. Okay. Now, there's a second piece to these employee stock option plans where it has a ordinary income tax component to it and then a capital gains. Now, they can happen simultaneously, or one can happen before or after the next. Okay, so the ordinary income tax aspect is that your general. That's what you sit at. That's where everyone sits at, right? The capital gains happens after the ordinary income tax takes place, right? That means you've left the money there or you left the stocks there and they've just been investing on their own. Okay. Now, if you've held that stock for, let's say, 2 years, you can expect to enjoy the favorable capital gains rate of either 0%, 15%, or 20%, whichever you fit in based on your income. Now, it's favorable because it's not your regular ordinary income tax rate that can go up to 37%. So oftentimes folks may want to hold on to it for some time so that they can kind of enjoy that benefit. But ultimately, before you do anything dealing with employee stock options, you want to make sure that you're touching base with your financial advisor, your tax planner, to make sure that as these things are happening, you have the financial bandwidth, the capacity to handle the events that will come after you go ahead and either invest, exercise, or sell. Right? So that concludes it for today's video. We talked about bonuses and employee stock options and how they may have triggered you to owe taxes. Right. So ultimately, above all, you want to make sure that you're addressing your employer surrounding that 22% rate, especially if that's not where you sit. And of course, meeting with your financial advisor and your tax planner to ensure that you are planning strategically to kind of handle all that's going to take place with the stocks that you may have in your possession. That's all for now. I will see you next time.